Hey everyone, Meet Kevin here. Welcome back to another episode of the Meet Kevin Show. In this video, we are going to talk to Ross Gerber, co-founder of GerberKawasaki.com, link down below, registered investment advisor. They've also got an ETF, ticker symbol GK. We're going to talk about Ross's opinion on what the Federal Reserve just did to us. We're going to talk about the big warning that the Fed, via Jerome Powell, just gave us about the housing market with a difficult correction coming. And we're going to talk about what this means for the stock market, treasury yields, and much more. Let's get started by talking to Ross Gerber, registered investment advisor. Welcome aboard, Ross. Thanks for being here.
Hey, thanks for having me. Good to see you again.
Absolutely. So what happened, man? I mean, we got 75, but the market freaked towards the end of the day.
Well, I think it was mostly kind of what I was tweeting about too, just people's lack of confidence of Powell's ability to really assess what's coming in front of us, because he's been such, behind the curve with everything that he's done over the last several years. So when you're thinking about what's actually happening in the bond market that I was trading today, I'm buying bonds that are yielding 4% out for a year from the US Treasury. And I haven't seen that in a very long time. And what it does is it sucks money out of the stock market. And so for me, we have capital, we have lots of cash. And so like if you can get 8.5% on a pretty decent set of corporate bonds or over 5% now tax-free in California municipal bonds, which implies a 10%, what we call, taxable equivalent yield. If I can get 10% from the state of California, it's real hard to argue that stocks are as, beautiful as they used to be when you used to get nothing. You used to get nothing from these people. So now we're in an environment where people like me have a lot of incentive to increase our cash flow through buying these bonds, because during the Volcker era, one of the best things you could have done was just buy the bonds, and ride them for 30 years. And, when I started the business, there were bonds maturing from the Volcker era. And so it was like 80, 81, 82 rates were, let's say 15, 17, 18%. You got an 18% US Treasury bond guaranteed for 30 years. Like, think about the gift that Volcker gave people who had cash at the time to get guarantees. And so, I think really the market and me has little confidence that Powell will somehow like manufacture this ideal situation. And my real estate friends say, there's no such thing as a soft landing. And there's a lot of truth to that.
Now, why treasury bonds if potentially you're paying more in opportunity cost in the event that you could, maybe pick up stocks at a discount or real estate at a discount?
Well, what we do is we buy them over time. So they mature. It's not like one bond for, let's say, $100,000. It's 10 bonds for $10,000 that mature each month. So then we can dollar cost average either back into the market or back into the bond market. But you buy a guaranteed bond. So as interest rates change, you don't lose money like you do in a fund or a mutual fund or ETF of bonds, where you lose money as rates go higher, even though your interest payments go up. But if you buy a bond and hold it to maturity, you are guaranteed, as long as that issuer stays in business, or the government in this case, you're guaranteed to be paid off. So if I take 3.5% a couple of days ago and now it's 3.7, it doesn't really matter. Even though it looks like there's a loss, it's going to mature in the next year or 7 months or whatever. So as the bonds mature, you buy stocks and you dollar cost average into the market, which is the best strategy you could have in the next 6 months, knowing all the volatility that Powell intends on creating.
So you could even go down to the 6-month treasury, so to speak, if you wanted to take a little bit less than the 1 year and then just spread those out. Like this month, if you got 100K, buy, $20,000 of the 6 month, next month, do it again and again and again. And then 6 months from now, here's your, 20 grand plus interest. Here's your 20 grand plus interest, and so on and so forth.
Right. And so like you can let's say for me, I think November is when things might start to look a little better for stocks. Plus we have the election and that will be done. And plus we'll have earnings from companies, which I think will be better than expected. And I think that we'll see a lot more of the effects of Powell's, slamming the brakes on the economy in numbers in November. And then you'll start to see that as they get to 4%, which is clearly they want to see rates in the 4% range, people are just going to have to get used to this because it's a restrictive monetary policy. So the point of a restrictive monetary policy is to hurt people. And that's the part where they talk these like, that's why I was pissed today. It's like they use this jargon to basically say 1 million Americans are about to lose their jobs.
Right.
I will cause 1 million Americans. A lot of them will be in the real estate industry. And a lot of them will be in construction. And, it's kind of perfect timing for what you're doing. I hate to say
that's
it.
right.
I'm not trying to pitch house hack, but, this is what you raise money for as a real estate investor, because as rates are slammed higher, I just got a mortgage right in that little dip, and in July, August. And thank God, because even if I tried to apply today for the same exact thing, it would be way harder and a much higher interest rate. So home buyers are dramatically affected by the Fed's action. Homeowners. So home inflation is increasing dramatically, because if I buy an apartment building, if I have to borrow it, let's say 5% against my apartment building instead of 3%, and then I have taxes plus costs, I have to make at least, let's say 8 or 9 or 10, you start to say, what gross rate do I have to make? And then I have to raise rents to make those deals make sense. And so as loans mature and people can't get new loans that are even close, like let's say you're a homeowner who bought a home 5 years ago and you have a 5-year IO and now it matures,
right?
And you're going to lose your house. So what Powell's saying in jargon is, I'm taking people's houses and I'm taking people's jobs, and that will slow the economy because there's a war in Ukraine and energy prices have gone crazy and COVID ended and we all went out and did everything at the same time, and it's caused all these imbalances. So what I'm going to do to slow it down is just get people fired and take their houses. And that system does work, but it's a super inhumane and it's a byproduct of weak economic and fiscal policies to have to use monetary policy like this.
Sure. Well, yeah, I mean, it sounds like just weak fiscal discipline, a little too much spending
for
there
sure.
during the pandemic.
For sure. The first person to blame is Biden. And now my office is like, oh, you said an anti-Biden thing today, and I'm like, listen,
that's right.
I was a Democrat. I voted for it. People are like, yeah, Ross, you voted for him. And I'm like, yeah, I did. I voted for him. And it's not even that I dislike him per se, but I live in this world with people. And for the first time in as long as I can remember, people who don't make a lot of money, people at the lowest end of our income level, are seeing wage gains like I've never seen. Like, it's always the rich get richer and the rich gets richer. That's true. There's no question about that. So when you see actually the lower income people actually getting wage gains, and you could say, oh, well, they're losing it to inflation, but the inflation is temporary, but the wage gains are permanent. You see what I'm saying? Nobody's going to call the union and be like, now it's time to lower wages because prices went down. Powell killed the economy. Prices went down. So all of you now have to take less money. That never happens in the history of wages, right? Unless there's a Great Depression kind of thing, right? And so we're really in an interesting environment where we have too much demand, so much demand for labor and hotels and restaurants, and theme parks and every construction and everywhere, that we have to somehow like get people fired and whatever.
Now, so you mentioned like Q3, Q4, you're thinking we should have good earnings. I would imagine at least at some companies, some I'm sure will do poorly. What's your take on all these calls for, hey, look, we had our PE multiple contraction in the first half of this crash. What's your take on this idea that the next half of the crash is going to be a decline in actual earnings? That, for example, when Netflix year over year revenue is down 1% and their earnings are down 5%, that was Q2 to Q2. What happens when we start seeing Q4 to Q4 going back to like the crazy euphoria of November of 2021? Isn't it possible that we could see some massive minus signs for a couple quarters and essentially have an earnings recession?
Yes and no. So obviously everything's possible. The way I see it right now from the companies that I know and do business with, and so there's been a massive shift between the digital economy and the physical economy. So as it switched during COVID to the digital economy, and the Zooms of the world, prospered and hired tons of people, now it's switching back to the physical economy. And we're like, oh, I need somebody to work at a restaurant or hotel who can actually like figure out what to do. And so it's like the jobs that are being lost are different than the jobs that are needed. And it creates these weird situations. So people who have higher educations are much easier to find jobs than people who just, let's say, work in sanitation or something, lose their jobs. Like they do sanitation. And so I think our economy is shifted in a way to a better economy where manufacturing, like think of the factory announcements that have been announced between battery and EV manufacturers. Think of the demand for automobiles right now. One of the biggest causes of inflation is the rise in price of automobiles. We have a severe imbalance. We need chips. We need factories. Like this is great, but it causes a certain level of inflation because we're paying Americans to do it instead of Chinese people to do it. Okay. So if you repatriate these industries, like it's our goal, the inflation rate should be more like 3%, but the growth rate should be more like 3%, and rates should be like 3.5%. And that's a great world for stocks and everybody.
Would you call on the Fed to raise their target of inflation from 2% to 3% then?
Well, yes and no. I think the Fed is happy if it said 2.6. You see what I'm saying? So 2.7, 2.8. And the long-term rate of inflation has been 3% over the long term. So when we do a financial calculation for a retirement client and, you're 35 and you're like, how much money do I need in retirement? Well, we figure 3% inflation over the next 30, 40 years, right? So your cost of living is going to go up, maybe 150% by the time you retire, So when you start, figuring out, it's going to be 8% inflation. Well, the only economies that have had 8% inflation for 20 or 30 years are like Cambodia. And so it's like,
sure. Well, and they collapse.
Right. And so like, we're not at risk of running 8% inflation past right now. Okay?
Yeah, right.
So when you compare year over year, just like you're talking about the risk with earnings, the risk is the same with inflation. When you compare year over year, a year from now, it's not going to be the booming inflation of the beginning of the war and the Russian cutting off the oil and all this kind of stuff. And now you're comparing, you might see deflation. That's what Kathy and Elon are talking about, which is, I think, a real possibility with the plan the Fed has. And that's why stocks don't like it. And that's where you get this negative earnings potential. And then you have the dollar. So the dollar is one of the reasons earnings might look worse than they really are, is because a company like Soho House is a stock that I look at and know, and I own a little bit of personally. And they have two businesses, one here in the United States and one in England, really. And so like they collect just as much money in England as they do in the United States from their members. And the value of that money in dollars is dropping. So if they come back and bring that money back to the US, it's like they lost a lot of money because they have operations in England. But the English operations are doing fine. There's nothing wrong with the company. You see what I'm saying?
So
Apple is an example of this. Like Apple, unless they've severely hedged the dollar, which they don't usually do,
right?
Like essentially they're losing, and then they have to raise prices in those countries, and then we're less competitive in the world. So what Powell is also doing is making American products less competitive in the world. But if I want to buy a house in London, which is maybe also an idea if you're a real estate investor, is looking at international opportunities because the dollar is so strong. So you can go to Brazil, or you can go to England, or you can go to Mallorca or Italy and buy a beautiful place, and just the dollar change. What a good deal.
No kidding. I mean, when's the euro been at $1 or less?
Yeah, now, like in the paper where it's like, oh, the deal was 100 million euros, and it used to convert, and they'd be like $180 million. And I was like, that's so unfair. And and then now it's like 100 million euros, and that's like $99 million. And I was like, yeah,
There you go.
like, let's go to Europe, But other
I
than
mean,
going to Europe, it's not good for U.S. businesses. And that's where you get the earnings decline or potential earnings estimates revisions, but less so because the businesses aren't doing well, but more so because you have this imbalance that Powell's created. He's literally taken the rate, the 2-year rate, from 0 to 4% now. Okay.
Yeah.
In like the shortest period of time. And the market's actually done okay. It's hard to say that considering
yeah,
the entire paradigm shift that we're going through right now. So once the paradigm shift happens, which seems to be completing towards the end of the year, and we all start accepting, restrictive monetary policy, 4% rates, really, the high 3s, 4% rates, and mortgages and equity lines that nobody can afford anymore. And then, the houses start piling up, right? And then the numbers start looking bad. And then Powell's like, oh, God, I didn't look far enough into the future. And he's got to backpedal now. But the economy is like a big ship. And once the economy shifts in the wrong direction, you can't just be like, change it. So we've got this great momentum. And the idea is you want to just like apply the brakes, modestly right now. And it's okay to have a little inflation. Remember when they used to say that? Like, I can accept a little bit higher inflation for the growth that we're getting as long as the trend is down.
That's right. They had they called it FATE, which was kind of ironic, but they called it FATE, flexible average inflation targeting. Hey, it can run a little hot. That's okay. It'll average low.
Yeah, but like you have an economy that's so dynamic and so many disinflationary drivers, including an aging population and everything else. Why are you so worried about the 70s? Like that's the part that really pisses me off because I was born in the 70s. My earliest childhood memories are of inflation and waiting in gas lines with my mom. And I'm like, what the hell is he talking about? I remember that period of time, Volcker, really well, actually, as a kid. And it's like literally comparing like, Neil Armstrong landed on the moon to like SpaceX going to the moon. It's like, it's like, oh, well, they're both going to the moon, so we must use the same logic. It's like, no, we use a lot of different logic now because we have technology and we have these advanced abilities that we didn't have in 1977. We just didn't
to translate. What you're saying is we have so many disinflationary technologies today, things that should drive inflation down, that of course we're going to have some high level of inflation coming off this ultra stimulative period that we had, this insane period of growth of 2020, 21. And so of course, if we crest over that a little bit, we're going to look slightly negative looking in the rearview mirror to 2021. But we're still a booming economy. We're still the strongest country in the world in terms of economic might. That's kind of what you're saying, right?
And military might. Actually, I have a different theory.
Let's hear it.
A lot of things have changed because of this Russian invasion of Ukraine. And the weaponization of commodities is a new factor that economies of the world have to deal with. And that's one of the reasons we've seen runaway inflation is that Russia has used commodities. We're in the war with Russia, whether we realize it or not. And that's what pisses me off about Powell is he doesn't understand that keeping our economy strong right now is critical to beating Russia. And when September 11th happened, it was in a rising interest rate cycle after the dot-com boom. Okay, I lived through this, remember it very closely. Things were going very well, got too crazy, and Greenspan raised rates too far, just like Powell, and we got the 2000. But markets were way, way more expensive at the time. It went from like a 32 PE to a 16 PE, and it was brutal. And then things were kind of getting better in 2001, but the economy was hobbled, and that's when Bin Laden hit. Bin Laden hit us when he knew that it would have maximum economic impact from the terrorist attack because the economy was kind of hobbled from rates being too high. And it led to the worst 3-year bear market in history. It was a 3-year bear market. There has been no longer a bear market than that period of time. And I lived through it, and it was like people complaining today, we're almost on a year bear market, which sucks. And by all means, but boy, imagine 2 more years of this. So imagine if there's something that happens that you're not expecting right now, because we're just all comfy here in America and not thinking that our enemies could even attack us here. And it's just, it's like this thinking is not best for America, and that's what pisses me off.
That's really interesting. So this argument that, hey, I mean, I don't even know that I've made this connection that, oh my gosh, maybe Osama bin Laden did perfectly time his attack
Yes.
for not only that calendar date, but also while we were in a recession, right? And that could happen again. I mean, sure, we've got Russia and Putin going crazy, but that could happen with China or somebody else.
Well, remember, we're entering a very dangerous period now that Russia's losing the war in Ukraine.
Mm-hmm.
If they won the war in Ukraine, there was a certainty, oh, they're going to win in 3 days. It's kind of like the old days again. Putin wins and whatever, and Europe just goes about, they're putting their head in the sand, like they've done in every conflict. And then it's like, oh, Ukraine's winning now. So now Putin is mobilizing the people of Russia. They're literally not allowing young Russian males to leave the country now or travel. They must enlist to the army. It is a draft. And so Putin is doubling down now on Ukraine. So he's going to pull innocent civilians out of his country who have no military experience and try to train them in some sort of short period of time to go take on one of the worst situations you can imagine for combat, right? So a lot of more Russians are going to die, and unfortunately Ukrainians too. But the end game will come in the next 6 months because winter is coming. And so Russians fighting in Ukraine in winter as he mobilizes is going to be known in history as one of the worst winters for Russian young men. So we're about to go through this period of time where the world order will be reordered. And China, because of zero COVID, is in a horrible recession, and because of over leverage, is severely weakened. So it's really a chance for America to take its strategic advantage, work with our allies in NATO, and make all of us stronger. The Europeans, Japanese, Australians, the Western countries of the world can unite now and create some sort of standard of what's acceptable in the world, instead of allowing India, Russia, China, Venezuela, Iran, the enemies of the world, Saudi Arabia, unite and use commodities against us. So by weaponizing commodities, they've hurt our economy and created inflation. Now we have the solution. It's called Tesla. It's called electric vehicles. It's called solar power. It's called renewable energy.
Nuclear.
It's called batteries. It's nuclear. We have actually tons of natural gas. We have wheat. We have everything Russia has, but technology. So there's 2 factors of disinflation: technology and the fact that we have a aging demographic. And so we have this natural problem in our society that can only be alleviated by having a lot more kids, which is what Elon talks about, or letting in lots of young immigrants, which is a wonderful solution. So right now is a critical period in our future that, if handled correctly, will put America as the leader in a dominant military and economic situation globally, and could usher in one of the most profitable and wonderful times in our history if managed correctly.
That's interesting. Now, and do you think that the current rate cycle or path that is going 75 today, going probably to as high as 4.6 by for a peak at next year, some point in next year, before going back down in maybe 2024, do you think that's too aggressive? Should the Fed just relax and pull back a little bit and just chill for a bit, let the impacts of what they've already done be felt in the market, and just wait for inflation to lap those year-over-year highs?
Well, I mean, I'll put the question back to you. You're a real estate guy, okay? So you want to go buy houses, but you have to get loans to buy houses, okay? If a mortgage rate on a loan is, let's say, 6% on average right now, it goes to 7%.
Oh, yeah.
Okay, you're looking at 7% mortgages. Your incentive to buy homes, or the expected return you need to make it worth it, has to be much higher, which means home prices have to go much lower,
Yeah.
right? Now, Americans store a tremendous amount of their personal wealth in their personal real estate and their homes. And that's the main source of a lot of middle class Americans' wealth.
Yeah.
So, what Powell is doing is real bad for America and people's wealth. It's real bad. And Biden should be much more concerned about that than inflation, which these forces are going to bring down no matter what. So we have solutions for inflation that exist just from, because it's a capitalist system.
Sure.
And then we have this opportunity to like help Ukraine beat Russia, which is great, and then change the world order, which is what Biden should be worried about. But Powell's raising rates so high that here you are, an investor raising capital to buy homes and improve them and create jobs and create homes for people. We need that, don't we? We need more homes in this country. We need construction. Most landlords stink. I think that's a factor. I don't, people keep calling me and say, me, Kevin's, doing this and that. Is it legit? And this and that. I was like, listen, Kevin started in real estate. Like, Kevin is a real estate guy who went on YouTube, and he's creating a vehicle for investors who are accredited investors. And you should definitely do your research and, understand the risks of everything. But he legitimately wants to build a company. He's an ambitious guy, and he's going to buy a lot of houses, I think, but he wants to be a good landlord. And I was like, you don't understand. I've rented houses for a lot of my life, and bad landlords are everywhere. And I've gotten more involved in the real estate industry, also thanks to you and another group of people who are longtime real estate family I've been working with as outside business activity. And, I've become fascinated with the real estate industry because I actually don't know a lot about it. And so I've been learning so much, and it started actually in the real estate boom. I started learning about it, and then I learned a lot of bad lessons. And then over the years, I've learned a pretty decent amount, but now I've like kind of dived into it because there's so much different real estate. But investing in homes and being able to get access to capital to create jobs is crucial for the economy.
Yeah, that's a really good point. So what do you think then when Jerome Powell warns that, this was the first time he mentioned it so directly. In June, he mentioned, if he was a first-time home buyer, he would recommend waiting for a pause or a reset in the housing market because he knows they're raising rates like crazy. Now,
so
today,
you call your wife and be like, Jerome said we shouldn't buy this house now that we're having our baby.
Yeah,
we're going to stay in our little 1-bedroom apartment. We were about to buy the house, but until he jacked up rates, now we can't afford it. So, honey, Jerome just said, wait till next year after we lose our jobs. Yeah. Then we'll be able to afford it.
Well, so he clarified on that today, and it wasn't good. He said, quote, actually, I'll pull up exactly the quote, but the words he used were that we would go through a, quote, difficult correction in housing, and that we need to get back to equilibrium in housing, which basically means prices coming down. And so for him to say difficult correction, that implies a more than 20% drop in housing, which I think obviously for the purposes of House Hack and the raise we're doing at househack.com, obviously this is not a solicitation, read the PPM there. Right. It's an opportunity to buy, but it's painful for a lot of people. And like you mentioned, I think there are going to be a lot of construction people out of work. Contractors should consider starting to save money now. I went on a podcast in April, a shout out to Matt Reisinger, really great construction guy out in Austin, Texas. And I said, look, this was back at Gigafactory time when I was out there with you at Tesla.
That was really fun.
That was really fun. And, I warned on his podcast, I said, look, the contractors who follow you need to prepare, because when this housing market slows down, the glory days are going to pause for contractors. And you need to be prepared now, because if you go into this high in debt, you're screwed. So, what are you telling people, because you're obviously an advisory firm, so people can call your firm, link down below, and they can get financial advice from you. They can, and from your company. What do you say to people right now? Is now the time to get out of debt? Is now the time to try to increase your income, stabilize your job? Like, do you buy a house now, or do you wait until, maybe a year or two goes by and then you buy the dip on housing? What's your take?
Well, I just bought a house. So, my take is relative to my situation, which there is no supply of houses in West Los Angeles, none. I've been renting for 7 years, and my landlord guy is an a-hole and wouldn't sell us the house no matter what. And he panicked in June when rates soared, and he felt that real estate had peaked. So he was like, now I'll sell it to you, and like, obviously I bought the house, not trying to like time the market. I bought the house for my family that we live in it.
Could you be unique? I mean, how long have you lived in this house? And this, I want to make it
4 years. So
this, you've lived there for years. This isn't like a tract home or something you could easily replace, right?
No. I mean, I'm fortunate enough to live in the Palisades. So in Pacific Palisades in California, where there really isn't any houses for sale. So like if you put a house for sale here, it just sells in a minute because there isn't any. And they're very hard to get, so I was very happy to get it. But that said, when you look at a real estate market, let's say a whole state like California or a state like Arizona or Nevada, you have high-end real estate, which, it never really gets hurt that bad. But then you have everybody else. And so the markets, you think about the markets that gain the most value in the last 3 years. Those are the markets that are most vulnerable to lose the most value, just like in the stock market. So what I try to explain to people is why, if bonds are down over 20% and stocks are down over 20% and growth stocks are down 30 to 60%, why wouldn't real estate be down? Gold is down. Every asset's down. Every traditional hedge. I've had to explain this to clients for days now because people are not happy rightfully with losing money. And I'm like, look, every hedge that we have has lost money. Like there's only cash. It was really it. So if you're not 100% cash, that's the only position, or oil and gas, Russian rubles, and, but nobody owns that. So like if you own any sort of portfolio, you've lost money. So real estate in your portfolio is going to lose money. And we've seen it in the REITs. And so if it's in the REITs, it's just a matter of time till transactions happen. And then the prices start marking down. So there was such a lack of supply because rates were too low for too long. And then the Fed should have acted way sooner. There's such a lack of supply that what we see now is like a traffic jam of real estate. Like nobody's buying, but now it's like more houses are coming for sale and the inventory is rising, and it's a matter of time till people have to just cut prices to sell their homes. And you have to offset the 6.5% mortgage or whatever it is. And
so you're kind of drawing a contrast here that, hey, like personally for your situation, it made sense to buy because you've already lived in this home. Your seller actually started panicking, thinking that we were at a peak, and it was either you buy it or you have to move and you get kicked out of your neighborhood where you're raising children. You're contrasting that with like boom towns like Austin or Boise, right? Like blackmail, yeah. But boom towns like Austin, Texas, or Boise, or maybe parts of Florida or Vegas or Phoenix, where, like, for example, Open Door it was just reported that Open Door is allegedly losing money on over 70% of their sales in Phoenix.
It's going to be closed door pretty soon. It's really
ouch. So and so you think that we could have this location specific, essentially, correction, as Jerome Powell.
There's no correction going to happen in Manhattan. Now everybody's going back to Manhattan. My wife's there right now. It's packed. Fashion Week. Wow. I wish I was there. She was complaining last night. I have to go to Manhattan for work. I'm going to be so tired. I go, I have to watch the kids all week while you're in Manhattan during Fashion Week. I was like, is this supposed to be the other way? And then I pulled out the picture when I was at the stock exchange.
You want to go to Fashion Week?
With Adriana Lima, and then it went downhill from there. But that said, the old Victoria's Secret. I miss it. But so that said, Manhattan is booming again, and Boise is not.
So you think this is going to be very location specific then, and the opportunities are going to come in certain areas.
Right. It's so unfortunately more markets will be down than not down. Like where I like LA for example, as a market is like really like 4 cities. But one of the things that's happened in my area, like West Los Angeles, is the homeless problem has made some used to be really nice areas not as nice or safe. And so the ones that are, have become much more valuable because the government of our own city is so inept and ridiculous that they've made it unsafe and formerly safe places,
Right.
and so it's made areas like mine even more valuable because everybody's trying to find a place where, Mike Bonin is going to like, set up some sort of like crazy camp, and so, I think each city is different. The cities that benefited the most during the pandemic are the ones that are going to lose the most. But I also think there's enough people like you out there to stabilize the market. It happened during the financial crisis. There's lots of capital out there. People have jobs. See, it's a weird situation. It's like you have you're trying to cause a recession when everybody has a job and is doing well,
Yeah.
So once again, the economy is like plowing ahead too fast. It's kind of like, yeah. And then like Powell's like, stop it, stop. And like, I'm saying just like, push a little bit and let it ride, let people make some money, but Powell's like Volcker. And what does he think his legacy is going to be? It's like, I'm the guy who caused the worst bear market and the worst, recession. Well, you don't want to be that guy. So what upside does he have? And there's another downside. The government has to pay us this interest. Okay. When the government pays 2% interest on $30 trillion, that's $600 billion. If they pay 3%, $900 billion. If they have to pay 4%, it's $1.2 trillion. As you start talking like real dollars that the government has to pay, these are deficit dollars. Like, where is it coming from? It comes from you and me. They got to raise taxes now to pay the interest on the debt. Why? Because of Powell.
Now, some of that obviously takes time to roll off, and like not all the rates are going up immediately. But yeah, of course, it increases the cost of borrowing.
No,
and just slows everything down.
Most debt is short term.
When are you thinking we're going to see a Fed U-turn? Like, as frustrating it is that Jerome Powell is hiking like this. When do you think that U-turn comes? Because historically, when the Fed U-turns, that's buy time. So,
predicting elections and people hate now. You're going to talk politics. Listen, I have my own opinions, and you're entitled to yours. I think Americans want a good economy and they want a pro-business environment. And I think there were certain legacies of Trump that were really pro-business that people really liked. And as much as they hate Trump, they even voted for him because it was a really good business environment. And I think most people don't want Trump anymore or anything like him, but they want a pro-business environment. And I think candidates from both parties have this opportunity to be pro-business and get votes. And I think a lot of people are like me in the middle now, not, it's like, if I say anything like positive towards a Republican, it's some sort of like, I like Trump now. I'm like, no, everybody knows I hate Trump and I'm not a Republican. I hate the Republicans actually, but I have my opinions, and a lot of stuff they say I might like. And mostly I'm a Democrat, but a lot of stuff they say I hate legally. And
what
so
do you
it's
think
like,
if we get a DeSantis versus Newsom?
Well, I think that's the future. I think the future is DeSantis versus Newsom. And I think that election is super interesting to me. I would clearly vote for Newsom. So I don't like Newsom, but DeSantis is like, from the Stone Age. So like, seriously. You just listen to this guy.
Oh no,
I'm not a DeSantis fan. So that said,
so you dislike DeSantis more than, because you don't like Newsom at all. Like, you hate Newsom. So like, you must really dislike DeSantis.
I dislike Newsom.
Okay.
No, just ideologically, I'm not that far from Newsom. I'm a liberal. Right. I'm definitely a liberal. But DeSantis, I'm like pro-gays. I'm pro-happiness. I'm pro-women's rights. I'm pro-abortion. I'm not a Florida Republican. I'm a California liberal. I'm pro-weed. I'm pro-people's rights. Individual rights. I'm pro-labor. I'm not pro-union, but I'm pro-labor. So like, but fundamentally, I'm pro-business. and I'm
Yeah.
pro jobs, and I've created a lot of jobs at my firm. I think we have like 45 employees. It's
Nice.
a lot of jobs,
You
and I'm
added a couple
great.
more. I
We
thought you
added a
were like
lot, and
43.
as post pandemic, and then I'm super grateful for the support the government gave us during the pandemic in many ways that helped my company not only survive, but we grew and we created jobs and we did exactly what was supposed to happen. But now I've got this big company and it's a huge responsibility. And so when the Fed is it's hard for my business when assets are obviously down
Yeah.
20%. It affects my employees, it affects me, it affects everybody else's income, just like every other company's stock is down. These people work at companies, pensions, they can't hit their numbers, people can't retire. It's this whole negative cycle that needs to be really thought about from a humanitarian perspective, which Powell and the Fed seem to not be able to do.
Why do you think then that I mean, beyond the sort of global implications of having a stronger military or having control of commodities, why not take the fact that right now inflation expectations are low, raise rates to a certain level, get inflation down for sure, then go back to a normal kind of bull market? That seems to be what Jerome Powell is sort of arguing, that
Right.
look, inflation expectations are low. Now's the time to be aggressive, because if those get out of control, then we're really screwed. And we don't want to be really screwed. We just want to be a little screwed.
Right. And just the same, I say takes away the restrictiveness as quickly as he puts it on
Right.
to fix creating a really bad recession. And that's why I haven't sold all my stocks. And that's why I'm actually bullish. See, my job is super hard. Like in times of maximum pain is maximum opportunity. And in the stock market, that's now. And so I have to deal with, on one hand, all my clients who are dealing with this pain. I got to like support them through this process because that's what we do as financial advisors. And at the same respect, get them to stay and make investments right now, where it seems like, aren't you like driving a car into a wall, Ross? And I'm like, listen, a lot of what we do, this is the best possible thing that could happen for us, because we're in the electric car business. We're in the renewable energy business. We're in the computer chip business. We're in the AI and robotics business. We're in the consumer businesses like Nike and Disney that are cheap, and they're not going away. No. And Powell will be long dead and I'll still be alive. So it's like, all these old people, the Nancy and Joe, they'll be long dead and we'll be alive. So the stock market will be fine. Like it's going to come back as soon as the Fed is done, and they want to be done as soon as possible because they're tired of getting beaten up by me on Twitter every day too. Right. And so like, I'm really thinking, you got to hang on here. And as I said, you can buy bonds if you need something to do. Just buy bonds. You can get great yields out there, and dollar cost average over the next, I don't know how long it's going to be, 3 to 6 months. But I think in November, the election creates a tone change. And I think more setbacks from Russia and hopefully not too cold of a winter in Europe that causes a severe problem for them. If God sort of watches out for us right and the things fall right, as we get into the new year and the Fed says we're done and now we're going to watch, game on.
Nice.
So we just, like, this is the hardest part of my job, is you just got to sit on your hands. Until
no, I mean, it's true. Well, and
time,
that's to some degree what I mean. Like me personally, I'm a big fan right now of just slowly, like you say, dollar cost average into some of this pain into the stock market. And I think, and I want your comments on this as well. We'll move on to Tesla next after I say this, but I think Tesla is going to be one of those stocks that'll really survive this earnings recession potential.
Survive. I mean.
Well, more than that. We'll touch on that in a moment. But I do want to hit on that bond thing because it's really applicable what you just said. The bonds issuance and the rates we're getting to house hack and real estate. So with house hack, we're probably going to be at 25 million raised within the next 30 days here.
Wow, that's great.
It's amazing where we are so far. We're closing in on it, and so we expect not to buy homes though for at least the next 6 months.
Right,
And so
right.
one of the things we're thinking of doing is taking chunks of that, and like you mentioned, every month buying like 6-month bonds. And what's crazy is $25 million at a 4% treasury gives us our money back, rolling in 6 months. But that's a $1 million yield every
That's right.
year, just watching the real estate market collapse. And
Right.
so it's very, very
Right.
interesting to us.
Well, that was actually the cap rate just 6 months ago.
Yeah, that's true. That would have been your yield
if
for
you
real estate.
bought a building 6
Yeah.
months ago, you got a 4% cap rate, and now you
Yeah,
can just
yeah,
buy a
yeah,
treasury. And the guy who bought the building 6 months ago is about to shoot himself in the head.
Oh,
And
jeez.
yeah,
Oh,
your
gosh.
equity's
Well,
gone, sir. Sorry, Jerome is here. But you're
Jerome.
absolutely right. In fact, it's even better than that. Without much effort today, I was able to get my average yield up with really good securities. Like, we own MGM Grand hotels in GK and
Yeah.
for my clients, and they have bonds and maturing and all these things. And for some reason, I mean, the company's in the best financial position they have ever been,
What
with
broker are
plenty
you
of
using?
cash. Me.
Well, for the bonds, so you can buy
we
them directly?
trade. We trade through our custodians, and LPL and Charles Schwab are our two custodians. And so you
Got
go
it.
into their bond inventory and you buy bonds. And so if you want to do that, we can do that for our clients. And we do all kinds of things for our clients that I think
Do you buy
are
your
more
treasuries
sophisticated.
there too, or do you buy those through Treasury Direct?
No, we buy them through there as well, because
There, okay.
we have a very efficient technology and trading systems that allow us to build these portfolios of all these different bonds and maturities and types. And then you just sort of execute these trades in scale.
In bulk.
Because we manage, used to be 2.2 billion, it's somewhere around 2, I think,
Sure.
2 billion. So, like, I'll typically trade in a day, you're talking millions of dollars that I'll trade the days that I trade. And so in this case, I was a buyer, of bonds today.
Sure.
And so, so I think for, people, especially like a house hack, you just raise money. It wouldn't make any sense for you to deploy the capital right away, knowing the economic forecast that Jerome Powell just told you.
Yeah.
But yet you could still earn the same type of returns, because remember, let's say you buy a 5-year bond for MGM that yields 7 or something. And now Jerome cuts rates, right, in a year or two. Well, you can sell that bond. So you've collected the yield while you've waited. But now you can sell that bond, and the potential is that you can even make good money on those bonds when rates drop, when Jerome causes the recession. So
that's a good point.
So trading bonds makes a lot of sense right now, and using your capital, getting it out of the bank, getting it out of money market funds, and putting it into securities of different maturities is a very prudent investment right now, especially the guarantees you can get from the governments.
Yeah, which I believe is the only security we're allowed to call risk-free.
Nothing is risk-free, including the U.S. government, as you saw on January 6th. So, and we're not AAA rated, by the way. So I think Apple bonds probably are less risk, but that's, dude, Apple is like
what are they yielding now?
Machine. It's just a little above treasuries, right? It's like it's like 0.01 above a treasury.
Oh, wow. No spread.
Yeah, there's that. It's pretty funny.
So, okay, well, let's now talk Tesla. So here's my thesis, and then I want your opinion. So I believe for a lot of companies, we are going to see some form of pullback in consumer discretionary spending, and we may see negative year-over-year earnings. That'll vary for different companies, but I think we'll still have generally very strong earnings, because I think fundamentally America is still very, very strong. Now, Tesla, I think, is a little unique, though, in that I don't think we even are remotely close to potentially seeing an earnings recession, because when we look at Q3 of last year, we had about 250,000 deliveries. Yeah, and this year, Q3 is expected to be 369,000 or something like that. Q4
I have a bigger number than that.
Probably. Last Q4 was like 306 deliveries, and we're expecting that to be like 470 in Q4, maybe even larger than that. Maybe we'll get to that 500,000 number in Q4. In my opinion, That because Tesla has so much excess demand, an order backlog of around 400,000 vehicles, because of this extra backlog, and even if people cancel cars, 400,000 people decide to cancel cars tomorrow with Tesla, Tesla will still have so much demand that they'll sell all of what they're producing. And when we look back to last year, Tesla is going to be one of those companies where there's this big highlighter over it. Here's a company that's growing at a 50% clip. Its EPS is growing at a 50% clip. And I think the stock market's going to look and go, oh my gosh, that company's growing like crazy. And then they look at other companies, go, earnings recession, Tesla. Earnings recession, Tesla. Oh man, Tesla. So I'm pretty dang bullish on Tesla here. That's my largest position right now. What's your take?
My take is you've even missed a few points that I agree with everything you said and more. So you're also talking about, look at the rental car companies. Like, I'm going to get 160,000 EVs from GM, Hertz said today. Well, GM can't make EVs. So so the rental car company, so a company called Sixth in Europe just announced also they're buying all the Polestars and Teslas that they can find. Right. And so it doesn't even matter if there aren't individuals buying EVs, because the fleets all want to replace their gas cars with EVs. And it's an inflation killer. So there will never be any lack of demand for any EV for the next decade. Okay,
that's huge.
Write that down. Like, you invest in my fund.
That's huge.
We just added Rivian. I've got BYD. I've got Polestar. I got Tesla as my largest holding, because I am now 100% convinced that every EV, like, think about it. You drive around. Why would you pay $5,000, $6,000, $7,000 a year in gas? It's just crazy. And the next big thing are trucks. So you didn't mention Cybertruck next year and the explosion of EV trucks, hopefully next year, right? And so people want to replace their very expensive gas cars because it might cost $20,000, but you've got to service it. You got gas to pay for. You got oil. You got brakes. You got all the issues gas cars have, and then you've got EVs, which are all the EVs I've been in and been following and studying are great. There are very few I haven't liked, and the question is, can they make enough? And so Tesla not only will it's an amazing company. It's like, I don't know what else to say. Like, I was just talking about charging. Like, I've been working on autonomy, I've been working on autonomy a lot lately. It's AI Day coming up, and I did an interview and they were asking me all about autonomy and AI. And I start talking about the potential of these things in robotics. It's just, Tesla will not have any issue with earnings. The best thing that's happening is that their costs are going down. And they got the Tesla enhancement bill from Joe Biden that gives them tax credits for so many areas of production and for so many of their products. So Tesla and our whole climate investment, look at what just happened to Puerto Rico. Our whole climate investment in my fund and in my firm's main investment focus thesis is that climate investments are going to be the most important and consequential investments and profitable over the next decade. And I'm more convinced than ever, if Tesla goes down or any of these stocks go down, like Polestar's cheap right now, I try to add to positions, and I really have never had more conviction about an investment theme.
Wow. And I know you have to leave in about 4 minutes. So I want to say, first of all, really incredible point. I mean, even if buyer demand evaporated, the fleets will just buy up all the Teslas they can get their hands on. Great point. Really great point.
Listen, I just recently had an experience. Because I'm on full self-driving beta, and I was dealing with the beta people, and I had some issue with beta in my car, and I was dealing with the engineers and working on solving this issue, which I thought was one of the coolest things ever, because it's like you're contributing to the software, right? Yeah. Other than the fact there was this problem, right? But we fixed the problem, and then it just is driving better than ever, and like all by itself. And I'm like, the people working on this, I email these guys, and it's like Saturday night they're answering emails, Sunday morning they're answering email, Monday morning. Wow. And I'm like, these people are on a mission to
Nice.
change the world. And the people at Tesla, the people working at Tesla, are the smartest, most motivated people, I think, in the world. And that's what AI Day is going to be all about, is attracting more of those people. But
Wow.
it's truly inspiring, the breakthroughs that we'll see at Tesla over the next 5 years.
That's crazy. That's amazing. That's really, really a good anecdote. So 2 last questions. The second to last question is Elon and Twitter, man. What's going to happen?
Well, I wish I knew. I've been more than screwed on that deal myself. I'm not a lawyer. I have a understanding of law, and I have a belief system that Elon should have known the level of fraud at Twitter as an extremely intelligent individual with access to principals at the firm. I have access to many, or to people I know at Twitter, and I have had many interactions with Twitter myself that had convinced me much of Twitter is fake. But much of Twitter is also real. Much of Twitter is also real. And he should have known. So I think Elon is going to have to spend a decent amount of money to get out of this problem. I don't think they're going to force him to own the company because he doesn't want to run it. But unfortunately, Twitter is losing employees by the day, and they've lost direction, and Parag isn't qualified to deal with this in any way. And it's a really sad, slow demise of a great property that I'm on, and hopefully somebody will save one day, but it's not going to be Elon.
Last question is, there's a chance that I'll be talking to one of your favorite people on Wall Street, Mr. Vlad from Robinhood. And,
really?
I want to know.
You got an interview with Vlad?
Well, if that were to occur, what would you ask him?
Well, obviously you can just like beat the guy up. Everybody's done that.
Well, yeah, that's old news now.
Or you could try to. I think it's interesting what's happening to Robinhood right now. It reminds me of .com and Bust and E-Trade. And obviously millions of people use Robinhood, and it's an app that has been successfully integrated into many young people's lives. And it has the opportunity to do good if it focused on helping its users versus taking advantage of them. So I think the question for Vlad is, and I personally think that he is broken and they need new management, is he willing to leave the company for the better good of Robinhood? And that if he really wants to do what's best for users, they should sell the company to good financial operators and give their users an opportunity to have financial growth and security, like what I try to do with our clients, and instead of just trying to convince people to trade. And that might include not even being a broker anymore and switching to being an advisor and charging fees where you're not making money from payment from order flow or off commissions, because that fundamental conflict of interest between commissions and being a fiduciary like me is what most clients don't understand. As a fiduciary, I have to do what's best for my clients, and including finding the best deal for trades. And for Robinhood, it's the opposite. When you're a broker, and it's in their best interest to find you the worst deal for trades, and that's what you get there. And so I think if Vlad resigned and good management came in, Robinhood could be a very successful brand and build a great company if they really tried, and it would be a very cheap stock to buy if somebody else was running it. So that's the question. Is he willing to do what's best for Robinhood and leave the company?
Last follow-up, Sam Bankman-Fried. What if he bought Robinhood? Would you trust him in his leadership from FTX?
He's one of the scariest people I know.
Okay.
I don't know him, but I'm scared of him.
All right, deal. We'll leave it there. Ross,
thanks.
Tell us about your company.
Well, Gerber Kawasaki, you should reach out. This is the time to work with a financial advisor. Let's be real. Between the markets and real estate and mortgages and then the opportunities in the stock and bond market, having somebody take a look at your financial situation is probably one of the most important things that you can do. And we do a free initial consultation. So whether you have, $100 or $100 million, it doesn't matter to us at our firm. We have a program for you. And so I highly recommend reaching out, gerberkawasaki.com. The next 3 months is a really important time to position and get yourself prepared for this next leg of the financial markets, wherever it may lead us. But having a financial plan is one of the reasons that people like myself and our clients have a little bit better opportunity during these periods of time, because it allows you to be positioned to take advantage of these periods of time versus being over leveraged like at Robinhood, where then you end up getting just wiped out. So we're prepared to take advantage of this, and that's what a financial advisor can do for you, as well as being there for you. And we also have my fund GK on the New York Stock Exchange. It's the growth investments at my firm. Obviously, it's highly discounted right now, and it's led by Tesla. And about 25% of our investments are in EV related, 25% is in technology, 20% in the consumer, and then the rest in real estate and biotechnology and healthcare. So that's another way to get involved with our investments. But I think for investors, it's a great time to dollar cost average and talk to a financial advisor.
That's awesome, Ross. Thank you so much. I just want to make it clear to everyone that these interviews are not paid. No payment has been obviously received from Ross for this. So if you do go to Gerber Kawasaki, it's not sponsored. I love having Ross on. I think he provides great insight.
Thank you so much.
Important, of course, anytime. Also important to mention that Ross is on the board of HouseHack. He's a registered investment advisor. We're looking to diversify our governance. That's why Ross is there. And this is not a solicitation to invest. So you want to go read the PPM at househack.com if you want to learn more. Ross, did I miss anything?
No, but I do want to say, yeah, this is not an endorsement. I'm involved with Kevin because I think you're trying to do a good thing, and I'm happy to be involved. And I'm also trying to learn from you as well, because I think there's great opportunities in real estate, and you've done a great job in the past. But I, as a financial advisor, you should meet with us, and you have to be an accredited investor to be involved with HouseHack. And that's something also, if you work with a financial advisor, we can determine if you're an accredited investor and whether or not an investment like this is appropriate for you, because, private investments have different risks and long-term, time horizons, and are probably not appropriate for many investors. And that's what's most important, is determining what investments make sense for you. And that's what we do at Gerber Kawasaki. And I'm very excited for HouseHack, because I think it's going to be a great opportunity over the next 2, probably 3 years to build a portfolio of real estate. And I'm excited to learn and be a part of it too.
Awesome. Ross, thank you so much. We'll see you in the next one. Thank you everybody for watching the video, and feel free to share the video if you found it helpful. Thanks. Bye.